Hello, and welcome to Shamam Enterprises. I'm excited to share with you today one of the most compelling investment opportunities we've uncovered in 2025, Pakistan's fertilizer sector. Free stocks, over 100% returns this year. Dividend yields up to 9.6%, and they're still trading at significant discounts to emerging market peers. If you're looking for a combination of high income, capital appreciation potential, and defensive characteristics, you need to hear this story. Today, we'll analyze Fauji Fertilizer Company, Engro Fertilizer, and Fatima Fertilizer, three companies that are quietly delivering exceptional returns while most investors aren't paying attention. Let's dive in. First, let's understand why Pakistan's fertilizer sector deserves your attention. Pakistan is an agricultural powerhouse. Agriculture contributes 24% to GDP and employs 40% of the workforce. This isn't a niche market. This is foundational to the country's economy and food security. The fertilizer industry serves this critical sector with three dominant players controlling the market. This oligopolistic structure means limited competition, stable pricing power, and predictable cash flows. Now here's what makes this opportunity special right now. Pakistan's economy is stabilizing. The KSE 100 stock index has soared to all-time highs, up over 40% this year. Foreign exchange reserves are rebuilding. Inflation is moderating. And the fertilizer sector is benefiting from improved natural gas allocation and stable input costs. But despite this strong performance, these stocks are still trading at 8 to 12 times earnings, well below the 12 to 15 times multiple typical for emerging market fertilizer companies. This creates an attractive entry point for investors who understand the fundamentals. Let's start with Fauji Fertilizer Company, ticker FFC, the sector's blue-chip leader. Current price, 589 rupees. Market cap, 839 billion rupees. FFC has delivered 96.56% returns over the past year. But this isn't just a momentum story. The fundamentals are exceptional. Return on equity, nearly 35%. Net profit margin, over 20%. And here's the kicker for income investors: a 6.19% dividend yield with a sustainable 60% payout ratio. FFC benefits from military backing through the Fauji Foundation, ensuring disciplined management and strong corporate governance. The company has diversified beyond fertilizers into energy, including a 330-megawatt power plant that just achieved commercial operation in October. With a beta of 0.79, FFC offers lower volatility than the broader market while delivering superior returns. It's the perfect core holding for investors who want stability, income, and exposure to Pakistan's agricultural sector. Our 12-month target, 680 rupees. That's 15% capital appreciation plus the 6% dividend yield, a total return potential of over 21%. Now let's talk about Engro Fertilizer, ticker EFERT, the income champion of this trio. Current price, 223 rupees. Market cap, 298 billion rupees. If you're an income-focused investor, pay close attention to this one. EFERT offers a 9.63% dividend yield. Let me repeat that, 9.63%. That's extraordinary by any global standard. Compare this to the S&P 500's 1.5% yield, or even emerging market averages of under 3%. EFERT is delivering more than triple the income of typical emerging market equities. But it's not just about the yield. EFERT has the highest return on equity in the sector at 59%, nearly double FFC's already impressive number. And with a beta of just 0.32, it's the most defensive stock of the three. EFERT is part of the respected Engro Corporation and operates a diversified portfolio including urea, DAP, and specialty fertilizers. The company has a strong brand presence and an extensive distribution network reaching farmers across Pakistan. While EFERT's one-year price return of 17% is more modest than its peers, the total return picture is compelling when you factor in that nearly 10% dividend. Our target, 250 rupees. 12% upside plus that 9.6% yield equals approximately 21 to 22% total return potential. For retirees, endowments, or anyone seeking current income with equity exposure, EFERT deserves serious consideration. Finally, let's discuss Fatima Fertilizer, ticker Fatima, the value transformation play. Current price, 144 rupees. Market cap, 303 billion rupees. This is where it gets really interesting for growth-oriented investors. Fatima has returned 127% over the past year, outperforming both FFC and EFERT. And yet, it's trading at the lowest valuation multiple in the sector. Price to earnings, just 8.67 times. Price to book, 1.99 times. Both represent significant discounts to peers. Why the discount? I believe the market is underestimating the company's transformation potential. Fatima recently announced a major corporate restructuring, transferring its Multan plant operations to a wholly owned subsidiary. This creates clearer business segments and could unlock hidden value. Additionally, through its subsidiary Fatima Petroleum, the company has been awarded participation interests in 2 offshore exploration blocks. This vertical integration into upstream energy could secure long-term feedstock and create value beyond core fertilizer operations. And here's the kicker. Fatima has the highest gross margin in the sector at 36.7%, suggesting operational excellence that isn't fully reflected in the valuation. Our target, 172 rupees. That's 19% upside plus a 4.9% dividend yield, total return potential of 24%. For investors with higher risk tolerance and a 12 to 18-month horizon, Fatima offers the most compelling risk-reward profile in the sector. So how should you think about these 3 opportunities? Think of it this way. FFC is your quality anchor, strong fundamentals, military backing, diversification into energy. It's ideal for conservative investors who want balanced exposure with good income. EFERT is your income engine, nearly 10% yield, highest ROE, lowest volatility. Perfect for income-focused portfolios, retirees, or anyone seeking bond-like income with equity upside. And Fatima is your growth accelerator, lowest valuation, transformation catalysts, highest momentum. Best suited for growth investors comfortable with slightly higher volatility. Here's a suggested portfolio allocation for balanced investors. 35% in FFC for stability and quality, 30% in EFERT for maximum income generation, 25% in Fatima for growth and value, and 10% in cash for opportunistic additions. This blend gives you a portfolio yielding approximately 6.7% in dividends with total return potential of 22 to 27% over the next 12 months. For conservative income seekers, weight more heavily toward EFERT and FFC. For aggressive growth investors, overweight Fatima. The beauty of this sector is that there's a compelling option for virtually every investment style and risk tolerance. Now, let's talk about risks, because every investment has them. Pakistan is a frontier emerging market. That means political uncertainty, currency volatility, and potential policy changes. The Pakistani rupee historically depreciates 5 to 7% annually against the dollar, something USD-based investors must factor in. Natural gas supply can be curtailed during winter months, impacting production. International urea prices influence local pricing through import parity, and government subsidy policies could change based on fiscal conditions. However, several factors mitigate these risks. First, the high dividend yields provide a significant cushion. Even if currency depreciates 6%, you're still earning net positive returns in USD terms. Second, these companies trade at low valuation multiples, limiting downside. Our bear case analysis suggests maximum losses of 7 to 13% even in adverse scenarios. Third, fertilizers are essential products with stable demand regardless of economic conditions. This is a defensive sector. The key is appropriate position sizing. For international investors, consider limiting exposure to 3 to 5% of your portfolio. For Pakistani investors with lower currency risk, you can go higher. As always, do your own due diligence and consult with your financial advisor. Let me bring this all together. Pakistan's fertilizer sector offers a rare combination: deep value with PE ratios of 8 to 12 times, high income with yields up to 9.6%, strong growth potential with double-digit earnings trajectories, and defensive characteristics from essential products. FFC, EFERT, and Fatima have already delivered exceptional returns in 2025, but the opportunity isn't over. With attractive valuations, strong fundamentals, and multiple catalysts ahead. These stocks deserve consideration for 2026. Now, this video only scratches the surface. We've prepared a comprehensive 15-page research report covering detailed financials, technical analysis, entry strategies, and much more. You can find the full report on our SUBSTACK. The link is in the description below. It includes specific price targets, detailed risk analysis, and quarter-by-quarter monitoring points. If you found this analysis valuable, please hit that like button and subscribe to the Shamam Enterprises channel. We publish in-depth investment research on emerging market opportunities that most investors overlook. Drop a comment below telling us which of these 3 stocks interest you most, or if you have questions about Pakistani equities. We read every comment and often create follow-up content based on your feedback. And remember, the best investments often come from markets others are ignoring. Pakistan's fertilizer sector is one of those opportunities right now. Thank you for watching and happy investing. This is Shamam Enterprises, helping you discover exceptional investment opportunities worldwide.